In June 2026, something happened that's never happened before in the history of the stock market. Elon Musk's net worth crossed $1 trillion, making him the world's first trillionaire. And the reason wasn't Tesla, it was SpaceX. On June 12, 2026, SpaceX went public on the Nasdaq under the ticker SPCX. The IPO was priced at $135 a share, and the stock didn't just go up, it exploded. Within days, SpaceX's market cap blew past $2.5 trillion, making it bigger than TSMC, bigger than Tesla, and putting it in the top 6 most valuable companies on Earth, right behind giants like Microsoft, Apple, Google, Nvidia, and Amazon. To put that in perspective, SpaceX is now worth roughly the same as the entire semiconductor industry's biggest player, combined with several other household name companies stacked on top. This was also the largest IPO in history. SpaceX raised $75 billion a month. That's more than double what Saudi Aramco raised back in 2019, which had been the record holder for years. So today, let's break down 3 things: what SpaceX actually is and how it got here, how this company actually makes its money, and why this IPO happened now. But to understand how a rocket company ended up worth more than TSMC, we need to go back to where this all started, because the beginning of this story is almost the opposite of a trillion-dollar success. SpaceX, Space Exploration Technologies Corp., was founded on March 14, 2002 by Elon Musk. At the time, Musk was already a millionaire after selling PayPal, and he poured a huge chunk of that money into a brand new rocket company most people thought was insane. Building rockets is expensive, and most attempts fail. In fact, SpaceX's first 3 rocket launches all failed. The company was nearly out of money by 2008. Then, in September 2008, the 4th launch of the Falcon 1 rocket succeeded. And it saved the company. Months later, NASA awarded SpaceX a contract to resupply the International Space Station, and that contract became the foundation everything else was built on. From there, the mission became clear: make access to space dramatically cheaper, and eventually make humanity multiplanetary. The key to both of those goals was one idea: reusability. Instead of throwing away a rocket after every launch, like the entire industry had always done, SpaceX figured out how to land rockets back on Earth and fly them again. That single innovation is what changed the economics of spaceflight forever. Fast forward to today. SpaceX has completed over 620 orbital launches with a success rate above 99%. And some of its Falcon 9 boosters have flown more than 30 times each. From a company that almost went bankrupt in 2008 to a $2.5 trillion public company in 2026. That's the SpaceX story in a nutshell. Now, knowing that history, here's the part that surprises most people. SpaceX isn't actually making most of its money from rockets at all. Today, it's really 3 businesses operating under one roof. Let's start with the newest and most controversial one. xAI is the artificial intelligence company Elon Musk founded in 2024 to compete with OpenAI, built around its AI model Grok, which is integrated into X, the platform formerly known as Twitter. In February 2026, SpaceX folded xAI into itself, along with X, creating a single combined entity. The official pitch is that SpaceX's satellites and infrastructure can eventually host AI data centers in orbit. But here's the catch. And this is important: a high valuation doesn't automatically mean a healthy business. Look at it next to its competitors. OpenAI is valued around $850 billion and generates about $24 billion in revenue. Anthropic is valued around $400 billion and generates roughly $30 billion in revenue. xAI, meanwhile, generated only about $3.2 billion in 2025 revenue and posted an operating loss of roughly $6.4 billion. In plain terms, xAI is burning enormous amounts of cash, driven by spending on data centers and AI infrastructures. And it's currently the most expensive part of SpaceX's entire operation. So if AI is the part draining the money, what's actually keeping the lights on? That brings us to the business most people associate with the SpaceX name in the first place. Yeah, the rocket business that built its reputation. This segment covers launching satellites, cargo, and crewed missions to orbit, including resupply missions for NASA, primarily using the reusable Falcon 9 rocket. SpaceX is also pouring billions into Starship, its next generation mega rocket, with over $15 billion spent on development so far. The long term goal is almost unbelievable, getting the cost of reaching orbit down to around $100 per kilogram. But here's the twist: even this iconic segment lost money. It generated about $4.1 billion in revenue in 2025, but posted an operating loss of around $657 million. Mostly because of how much is being reinvested into Starship's R&D. It's a relatively small slice of the company too, making up only about 22% of total revenue. So between an AI division burning billions and a rocket division still spending more than it earns, you'd think SpaceX would be deep in the red. It's not. And that's entirely thanks to the third business, the one that's quietly paying for the other two. Starlink is SpaceX's satellite internet service. Think of it like an internet provider, similar to AT&T or T-Mobile, except the infrastructure is in space instead of underground. With more than 9,600 satellites in orbit and plans starting around $80 a month, Starlink has grown to over 10 million subscribers across more than 150 countries. In 2025, Starlink generated $11.4 billion in revenue. That's 61% of SpaceX's entire revenue. And it posted an operating profit of about $4.4 billion, a margin north of 39%. Starlink is by far the most profitable part of the company, and it's effectively subsidizing everything else SpaceX is doing, especially xAI's massive losses. That's exactly why investors love it. It's the cash engine funding the riskier, more expensive bets like Starship and AI infrastructure. The scalable nature of the business is the key. More subscribers means better margins, and the company is pushing hard to keep growing that number. That's the internal financial picture. One profitable engine carrying two expensive bets. Which raises the obvious question: if Starlink is already funding everything internally, why go public and raise outside money at all? The math. SpaceX raised $75 billion by issuing shares at a fixed price of $135 each. That capital is going toward a few very specific priorities. First, Starship development. The rocket needs continued funding to become fully operational and start generating its own revenue. Second, expanding the Starlink constellation with next-generation satellites to maintain its lead in orbital internet. Third, and maybe most urgently, funding the AI build-out. The xAI integration is driving enormous operating losses, around $4.3 billion in the first quarter of 2026 alone, largely tied to building out data centers and compute infrastructure. There's also a simpler, less glamorous reason behind the timing. Early investors, or venture capital firms like Founders Fund and other long-term backers, had been sitting on illiquid shares for over 2 decades. Going public finally let them cash out. So that's the real story behind SpaceX's trillion-dollar moment. A company that started in a warehouse, nearly went bankrupt twice, and is now valued above $2.5 trillion. Built on 3 very different businesses. One that's losing billions betting on the future of AI, one that's still trying to prove its next mega rocket can pay for itself, and one, Starlink, quietly funding the entire operation. Whether that bet pays off is the multi-trillion-dollar question Wall Street is now watching closely.